Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5 on the exact numbers. We haven't seen that level of unemployment, that low, that is, since the 1960s. And the Fed is absolutely looking at that. And of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk. But the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. They say you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Now, having said that, what else is the Fed missing? Well, wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah. So your real wage just went down. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years. It runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it. If you get inflation down and wages are constant, then the real wage goes up relative to where it was before. But if you're unemployed, you have no wage. So that's another issue. Now, what the Fed is missing, and it's a long list, but there's something called the labor force participation rate. Now, the labor force participation rate, you just take the number of people working divided by the total working age population. It's all you do. It's not sophisticated. And that number today is around 61.2, give or take, percent. But as recently as 2000, that number was over 70%. And it has come down ever since. And it dropped like a stone during 2020, during the pandemic lockdown. Came back a little bit, but not much. First of all, it's never 100%. It shouldn't be. There are legitimate reasons to be working age population not working. You're a homemaker. You're a student. You're an early retiree. There's a bunch of perfectly good reasons. So it's never 100%, not even close. But 70 is pretty high and 60 is pretty low. And the trend has been down. So that leaves, relative to kind of a normalized number, that leaves about 8 to 10 million people between the ages of 25 and 54 who are not in the workforce. And again, even if you allow for legitimate reasons for a lot of them, there's a big untapped labor pool. There are a lot of people who are sitting home watching, the football playoffs and not going to the unemployment office. That's the thing. You have to go to the unemployment office online or whatever. You have to at least look at a job to be counted as unemployed. If you're not looking, you're not counted as unemployed. But you're still a person. You're still capable of working. You're just not looking, which is a very negative sign, by the way. But if you took that group and threw it into the unemployment numbers, the way the Bureau of Labor Statistics calculates it, unemployment would be about 9%. That's a depression level of unemployment. The dollar, of course, it was, on a tear in 2021, most of 2022. It got to levels maybe technically not higher than 2000. Now, dollars come off a little bit, kind of starting in October, but I think that's about at the end of its adjustment, and the dollar's going to get stronger again. And the reason I say that is it's consistent with everything else we're talking about. If we're talking about the kind of recession that I've described, and if we're looking at the kind of yield curves, apart from the fact that it's reliable warning of recession, which it is, what's behind the curtain? What are the real reasons why the yield curve is inverted? It's sending a very bad signal. We interpreted the signal, but why? Why is it happening? The answer is there's a mad scramble for dollars. There is a serious dollar shortage, and people roll their eyes. They're like, wait a second, China's dumping treasuries, Brazil's dumping treasuries, people hate the dollar. China's talking to Saudi Arabia about paying for oil and yuan. What do you mean there's a dollar shortage? Well, there is, and we can see it, but there's a reason for it. 1 quadrillion is 1,000 trillion. That's approximately the notional value of all the derivatives, off-balance sheet derivatives of all the banks and hedge funds in the world. It's about 1 quadrillion. We're talking options, futures, swaps, swaptions, FX forwards, the whole thing, but they're all off-balance sheet. So they don't show up in conventional ratios. You got to read the footnotes, and they don't tell you that much. So, okay, what supports that? How do you get a $1 quadrillion position, 1,000 trillion? Well, the answer is collateral, but not that much. It's a little sliver. It's kind of like 1% collateral under the 1 quadrillion. Okay, so in a credit crunch, you're going into recession, which is where we are. What do banks say to each other, and what do banks say to the hedge fund clients, et cetera, in terms of the quality of collateral? They say, I don't want your mortgages. I don't want your corporates. I don't even want 10-year treasury notes. I don't want 5-year treasury notes. I want treasury bills. That is the best, least volatile, most liquid, most creditworthy instrument in the world. And in a world where balance sheets are contracting, credit fears are rising, the economy's turning down, everyone's worried about this. Well, if you're Deutsche Bank or Barclays or HSBC or Unicredit or Banco Santander, you have a central bank that doesn't print dollars. ECB can print all the euros you want, doesn't print dollars. Where are you going to get the dollars? Well, if you want to buy dollar-denominated treasury bills, you got to get dollars. The first point I would make is that global recessions are rare. Recessions in individual countries or economic communities like the EU do happen with some frequency, but a global recession is different. It's usually the case that even when a large group is in recession, somebody else is expanding. China, the 1970s used to call the U.S. the locomotive. If Germany was in recession, somehow the U.S. could kind of power through, although the U.S. itself had 3 recessions between 1974 and 1982. But a world recession is rare. We had one around the time of the 2008 financial crisis, even though Australia did power through it, okay, and certainly in 2020 during the pandemic lockdowns. But they're unusual, as I say. It's usually one group is in a little bit of trouble, but another group powers through and even can pull the recession country or group out of difficulty. But when global GDP declines, that's rare. We are heading for exactly that. To understand that, let's take a look at some of the largest economic groupings, and I'll start with the United States. Now, the United States had a mild recession in the first half of 2022. If you blinked, you missed it. First quarter GDP was negative, not a lot, about 1.6%. Second quarter GDP was also negative, about 0.9%. So first half as a whole, we had negative GDP. The rule of thumb definition of a recession is 2 consecutive quarters of declining GDP. That's the rule of thumb. We had that. It's in the data. Having said that, it was mild, and third quarter GDP and fourth quarter bounced back. But if there was a recession, it was mild. What I'm talking about is a much more severe recession, much more difficult, much sharper drop in economic output, beginning about now with rising unemployment, slowing industrial output, slowing retail sales, and importantly, for investors, a very sharp decline in inflation. So this is one of the kind of mystifying points about the U.S. stock market. I mean, it seems straightforward to me, but market has their own dynamic. They're saying, well, if the Fed raises rates the way I've described and they cause a recession, the Fed's going to have to cut rates. That's called the pivot, the Fed pivot, and lower rates are good for tech stocks, so buy stocks. But think about that for a second. What if inflation comes down faster than the Fed thinks? And I think it may, by the way, I'll return to that. What if inflation comes down really fast and they get to the target rate sooner than they think? Does that mean they might have to cut? Well, it might, but what's good about that for stocks? I mean, if that happens, no one ever says, why did that happen? They just say, well, inflation may come down, interest rates may come down, so buy stocks. It's like, well, inflation may come down, interest rates may come down, but if it does, it's because we're in a very severe recession, exactly what I'm forecasting. And so if that's the case, stocks are going to plunge, 30, 40, 50%. So don't root for lower rates, or if you're forecasting lower rates, understand what that means. It doesn't mean the Fed chickened out. It doesn't mean life is wonderful and you should buy tech stocks. It means that we're in the very severe recession that I described, and I think we will end up there. And therefore, stocks are going to plunge. So, be careful what you wish for, as they say. My forecast is, yeah, they are going to raise rates. They're going to over-tighten. They're going to cause a very severe recession. And when they do, they may pivot at that time, but it won't be for good reasons. It'll be for very bad reasons, meaning we're in a recession and stocks have plunged. So don't buy into the Wall Street chatter as far as that's concerned. Because as I say, the Fed's going to over tighten. Now, why doesn't the Fed know this? Well, because they never know, because they have the worst forecasting record of any institution I can think of. Their entire history since 1913 is one blunder after another. And this will just be the latest in a long series. And so just to kind of summarize, the Fed's on a course. We know exactly what it is because they told us. All you have to do is listen to them and believe them. They're going to raise rates, let high rates do its work, do their work, and see the inflation come down, and maybe in 2024 cut rates. What I expect is they are going to raise rates for the next couple of meetings, exactly as I described, but they're going to over-tighten. The signs of recession are already present. The Fed's not looking at them. I'll come back to what they are, by the way. And we'll be in a very severe recession for a lot of reasons. And that's going to mean a plunge in stock prices. So if the Fed cuts rates, don't cheer too loudly, because it'll be in a world where a severe recession, higher unemployment, and crashing stock prices are the norm. I'd like to finish on can't call it a happy note, but global liquidity crisis. Now, I talked about a global recession, and people go, well, isn't that like your liquidity crisis? No. A recession or a depression is very different than a liquidity crisis or a financial panic. They're two different things. They can and do happen separately. In 2008, we had both. In 2008, a recession or depression and a financial panic converged. So they can happen together, but they don't have to. They can happen individually. What we're in for looks like a global financial crisis and a global recession at the same time, coming sooner than later. Now, why do I say that? There's a global dollar shortage. People go, wait a second. The Fed printed $9 trillion, which they did in 2020. It's come down since then, but they did print that much money. How could there be a global dollar shortage? Well, what people don't understand is that behind the curtain, off balance sheet, this is off balance sheet. You got to go read the footnotes and understand what you're reading. There are $1 quadrillion of derivatives. And for those not familiar with the Q word, 1 quadrillion is 1,000 trillion. So I just said the Fed printed $9 trillion. Maybe it's down to $7 trillion. Yeah. But you have 1,000 trillion of derivatives. And they have to be supported with collateral. Not 100%, not even 10%. I mean, kind of 1% or 2% is enough. But when you're in a liquidity crisis, banks are extremely choosy about which collateral they'll accept to support this quadrillion-dollar inverted pyramid of derivatives. And right now, what they're saying, because this evolves, it gets worse. It doesn't happen overnight. It can become acute overnight, but it happens over the course of a year or longer. What we see, the banks are saying, I don't want corporate bonds as collateral. I don't want your mortgages as collateral. I don't even want 10-year Treasury notes as collateral. The only collateral I want are short-term U.S. Treasury bills, to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. By the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. And then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now to know that number's going up. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. So when the Fed's on a mission, they actually don't care about the stock market. Here's what they do care about. They care about disorderly markets. And that's the key word. It's not, if stocks are going down, but it's, kind of little, 0.5% a day, 1% a day, trending down, lower highs, lower lows, trending down. The Fed doesn't care about that. They're not going to bail out the stock market. They do care if it's disorderly. When was it disorderly? Well, March 2020, at the worst part of the pandemic, it dropped like 30% in like 2 or 3 weeks. The fall of 2008, it was like somebody opened a trap door. The Fed does care about that because that kind of disorderly behavior can feed on itself and end up in a 1929 type scenario. So the Fed will get the memo, as I put it, stop raising rates and begin cuts when the markets are disorderly. That may happen. In fact, I expect it will, but we're not there yet. So there may be a pivot, in late August, or July thereabouts, but not because of Goldilocks, but because it's not a soft landing, it's a crash landing. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession. Now, the other half, what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So stock market's telling us Goldilocks, bond market's telling us, here comes, Hurricane Mitch or whatever. And then there's what I call the reality. And I guess I'm the storyteller here, but what I see is a kind of a hybrid. The Fed's doing what they're doing, right or wrong. Okay, they're doing what they're doing. The market has their own interpretation. I agree with the market, certainly the bond market, that the Fed has probably over-tightened, and they may pivot to say that there could be a rate cut in August. Maybe, I wouldn't rule that out, but for a really bad reason. In other words, if the Fed cuts rates, which they may, the pivot may be real. It's not because they engineered a soft landing and Goldilocks and everything. Oh, that's just right. It's because they screwed up as usual, as they've been doing since 1913. They over-tightened and they found out too late. And then they have to slam on the brakes or take the foot off the brake, if you will, in terms of rate hikes, and then pivot. And we've seen this movie before. This is exactly what happened in 2018. The stock market dropped 20%. It was like 19.9 or something on the Dow, so maybe not technically a bear market, but yeah, what's the difference? It dropped 20%. The Fed was tightening into that collapse. The Fed tightened on December 16th, 2018, only like 8 days before the Christmas Eve massacre, and after most of the 20% collapse had already happened. They tightened one last time. So what it shows you is that when the Fed's on a mission, they actually don't care about the stock market, this whole, Bernanke put and Greenspan put and all that. That's not how it works. The thing I would point out is that there are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. Lasted 9 years, and gold went up 2,200%.
The second great bull market was from 1999 to 2011. Gold went up, but just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. And we had a second bear market starting in 2011. Now, I had a very interesting conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times. And we were down in Dominican Republic at Casa de Campo. This is around 2014, but the bear market started in 2011, but it really fell off a cliff in 2013. So I said, Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just hit me right between the eyes and it stayed with me. And of course, he's right. He said, gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit. Well, we're not overheated at all. I've got gold at I would put it at $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, 7,000 first. So there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear. There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity, because I could care less. But if you just took the average, and there are a couple ways to think about it. Just take the average of the two prior bull markets I mentioned. So 71 to 80, 9 years, 2,200%. 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up. It's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years from 2015, that puts you out to 2025. And at 1,400%, it puts you at $15,000 an ounce off a 1050 base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is a pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less, you come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels, but if you keep printing money, you need a higher price if you want to reference gold and not cause deflation, which they don't. You're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar. Yeah, it's real money. It's nice to make the money. But if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. I mean, You can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it, a less hyperbolic curve. So logarithmically is the right way to think about it, but in dollar terms, the percentage increase gets to be pretty small at those levels. And when I say $15,000 an ounce, I don't think I'm stretching. I mean, could it be 25,000, 40,000? I mean, just take my monetary equivalent. If you use M2, and by the way, when I used M1 and did that math, that's with 40% backing, because historically 40% has been a high level of backing. If you take M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. My numbers, I think, are conservative. They could be much higher. But the thing I would point out is that the Fed dug a hole and they can't get out of it. And I said all along, but certainly, 2014, 2015, et cetera, as they did the taper and then they did the liftoff and then they raised rates and all that. I said the Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. But I also said they won't be able to do it. And that's exactly what happened in the fourth quarter of 2018. Between October 1st and December 24th, 2018, the stock market dropped 19%. It was 1 point away from a bear market at that stage. And then you had the Christmas Eve massacre. And that's when Jay Powell threw in the towel. He got religion. He said, okay, first he said, we're not going to raise rates anymore. Then he said, we're on pause. Then he said, we're actually going to cut rates. And then 9 months later, he said, we're going to end quantitative tightening, which was reducing the balance, the money supply. And then in September 2019, they started QE4, which is that was before before the recession, before the depression, before the pandemic. They were already in QE4 and cutting rates again. So they can't get out of it. Now it's worse. So they prove that the failures manifest. They prove that they can't get out of it. And what can they do? By the way, on monetary theory, I mean, you say, what's the secret behind I think it's garbage, by the way, but you say, what's the secret behind it? Well, the secret behind it is if you can issue debt and collect taxes in the money that you print, you can force people to accept the money because they need the money to pay their taxes. And if they don't pay the taxes, they end up in jail. Now you can get extensions or do whatever, but at the end of the day, if you manifestly refuse to pay your taxes, they will come and put you in jail. And the point is, it relies on state power. It's really a neo-fascist concept. It relies on coercion, the point of a gun, jails, and state power to enforce the confidence in money. Now and they say that. I mean, I've read Stephanie Kelton. She's the bright light. I mean, this goes back a long way, but I've met her, read her books and her book, I should say, and her articles. But they're very explicit about that. Now, I think that's completely wrong because there are so many workarounds and so many ways to get out from under that kind of state power. But they do rely on state power at the end of the day. So that's why it has this neo-fascist element.
The next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. They're going to come down. And if you like that action, you might prefer the 10-year note because a longer maturity has a higher, not to get too technical, it's called DV01, dollar value 1 basis point. What it means is that so interest rates come down a certain amount, 25 basis points, 50 basis points or whatever. And I said bond prices go up, which they do. But how much do they go up? Well, the answer is the longer the maturity, the more they go up. They're more volatile. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown. We're looking at all kinds of geopolitical risks. Stocks are coming down. Then interest rates are going to come down too. So when we say bond markets, Matt, we have to be careful which bond market. I'm talking about the U.S. Treasury bond market. The short-term treasuries, 4-month bills, 6-month bills, up to 1 year. From 0 to 1 year, they're called bills. From 2 years to 20 years, they're called notes. And the 30 years called a bond. So if you're an expert, you say bills, notes, and bonds, but they're all Treasury securities. But so I just want to be specific. We're not talking about corporate bonds, just to be clear, because those may do very poorly if a company's going to underperform. We're going to go into a recession. We're going to have you're going to see bankruptcies increase. Those corporate bonds are going to get hammered, but certainly junk bonds. But so we're talking about U.S. Treasuries. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So the interesting thing about 2 years is you get a high rate, but it's less volatile than a 10-year note. It's more liquid. And 10-year notes are pretty liquid, but 2-year notes are very liquid. So you can actually have the best of both worlds. You can have a shorter maturity, which means less risk in some ways, and a higher interest rate. So it's like I say, the best of both worlds. But the highest interest rate is actually from 6 months to 1 year. So those are very, very safe securities, and they're paying like 5.25%, not quite 5.5%, but between 5.25% and 5.5% for 6 months, for a 6-month treasury bill. Why wouldn't you just buy one of those? I mean, it's more than what you get in the bank. Now, the answer is, well, yeah, Jim, that sounds good. But if interest rates go up even more, you're going to lose money on your capital. The value of the note or bond will go down if interest rates go up. That's bond math 101. Rates go up, prices go down. The opposite is true. Rates go down, prices go up. So you can make or lose money, but that inverse relationship kind of throws a lot of people, but that's just how it works. So yeah, buying a 2-year note that yields about 5.1%, very liquid, very safe, good return, more than your bank will pay you, more than most stocks will pay you. Why wouldn't you do that? Well, the answer is, if you think the 2-year note is going to go to 6%, you might not like it, because you're going to, if you hold it for 2 years, you'll get your money back. But if you want to sell in the meantime, you're going to lose, you're going to have a capital loss. I think they're coming down from here on out. But if you accept that view, then the 10-year note is going to have the biggest capital gains. Now, again, it's riskier. When I say risky, I'm talking about market risk. I'm not talking about credit risk. You are going to get your money back, but from a market risk point of view, if you had to sell it, a year from now or 6 months from now, for that matter, if rates go up, you're going to lose a little money on the value of the note itself. But if rates come down, not only do you get the 5% interest rate, which is sweet, but you're going to have a capital gain on the note, because that's what happens when rates come down. So the big question is, have rates peaked? And I would say they have. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risk, stocks are coming down, then interest rates are going to come down too. So again, 10-year note is riskier. From a market point of view, not risky from a credit point of view, good yield, and a lot of capital gains potential. The U.S. is heading into a recession, and we may be in a recession. Everyone's like, wait a second, yesterday GDP was up 5%, and it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption, obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. And the fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. Now, they'd done enough to make the third quarter strong, but going into the fourth quarter, they may just not show up for the game. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were spending we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. So here's the Fed's dilemma, and it's playing out in real time. So Jay Powell gave, I lost count, 7 or 8 speeches, and they said the same thing every time. He said, inflation is job one. We're on a path to raise interest rates. We're not going to quit until inflation is under control. Now, there's a little wiggle room around that. Their target is 2. They actually look at personal consumption expenditure year over year, core. That's their metric. There are 15 ways to measure inflation, but that's the one they like. But even that is still over close to 5. It's a long way from 2. That's the point. You're trying to get to 2. They're a long way from 2. But there's something called the terminal rate. What's the terminal rate? Well, no one knows the number. I don't know because Jay Powell doesn't know. So we're all estimating. But the terminal rate, it's a rate that's high enough to bring down inflation on its own without further rate hikes. In other words, we can stop here and confident that inflation is going to come down without doing more. Because the conundrum is, okay, they've been raising rates since March 2022. Monetary policy works with a lag. Inflation peaked in July 2022, and it has been coming down ever since. Some months were, January was hot compared to December, but the trend has been down. So they're raising rates and inflation is coming down. So that's good. But here's what they don't know. Was inflation coming down because they were raising rates, or had they already hit the terminal rate and they just didn't know it? Because Wall Street was like, no, you've hit the terminal rate. Stop, please stop. You got this under control. The Fed doesn't believe that. One of the greatest blunders in monetary policy was Paul Volcker in 1980, who had started raising rates in 1979, and inflation was coming down. But then in 1980, we had a very sharp recession that had nothing to do with monetary policy. It wasn't caused by Paul Volcker. Jimmy Carter put a cap on credit card interest, and banks stopped issuing credit cards. So, well, that'll sink the economy. And then so Volcker reacted to that by lowering interest rates 7 percentage points, not 70 basis points, 7 percentage points, because we're in a recession, right? That's what Feds do. The Fed chairs do. But because it was a regulatory blunder, they fixed it and the economy came roaring back. And then inflation really took off, worse than when Volcker got in 79 and early 1980. So Volcker had to take rates to 20% to get inflation under control the second time after cutting them in 1980. And that's called the Volcker mistake or the Volcker blunder. And Volcker himself, I spoke to him, he said, yeah, that was a mistake, that I should have stuck to my program, not worried about the economy and unemployment, but just got inflation under control. But when he threw in the towel prematurely, the inflation went to the moon. Jay Powell doesn't want to be that guy. Jay Powell knows that episode as well as I do. And he doesn't want to be the guy who throws in the towel early and then inflation just goes to the moon and then he has to take interest rates to 15% or something ridiculous. So Wall Street's saying, you're already there, mission accomplished. Powell's saying, not so fast. They told Volcker that and he cut rates and it was an enormous mistake. So Powell's not going to be that guy. So what is the terminal rate today? I would say 5.5, because we had a lot of hot data, unemployment down, job creation up, retail sales up, not to the moon, but these are the opposite of what Powell is looking for. So he's had no confirmation that inflation is coming down on its own. He's had a lot of data that says inflation may be getting ready to take off again. So you got to say the terminal rate went from 5.25 to 5.5, maybe more. And Powell always said, I don't care if there's a recession. I don't care if there's unemployment, because the long-term costs of inflation are going to be much greater than those short-term problems. We got to suffer through that to get a bigger problem under control. He thinks of inflation. He said this many, many times. Now, along comes Silicon Valley Bank, okay? Oh, by the way, in addition to raising rates, don't forget QT, quantitative tightening. They were shrinking their balance sheet. It's very hard to estimate the monetary impact of shrinking the balance sheet, but the best estimate is for every $1 trillion you take it down, it's probably equal to a 1 percentage point hike in the Fed funds rate. So The tightening has been more than just taking the Fed funds rate up. You also have to take into account QT. Now let's go back to the bond guarantee bailing out the entire banking system. The Fed proceeded to guarantee every deposit and every bank in the entire U.S. banking system. Here we're talking, $6 or $7 trillion of assets. And the way they did it was a lot of other banks, big ones and small ones, at least the big ones had good risk management, but a lot of small and medium-sized banks, they had the same problem Silicon Valley Bank had. Maybe the depositors weren't walking out the door, or maybe they weren't funding tech startups, but they had underwater bonds and overnight deposits, and were facing the same thing. So the Fed said, okay, all you banks, if you send us your bonds, we'll give you cash. Okay, that's just a normal discount operation, but that will give you cash equivalent to the par value. So again, remember the market value is like 80 cents on the dollar, but the Fed says we'll give you 100 cents on the dollar. So now you ship your bonds to the Fed. They give you not 100%, which is like low collateral, but they give you 120%. So the banks are shipping in bonds that are worth 80 cents on the dollar. Why wouldn't you do that? I'm like, hey, Fed, if you want to give me a low interest rate bridge loan with 80% down, I'll take all you got. So now the banks are going to do that. And by the way, because it's structured kind of like a repurchase agreement, there's no sale. So they don't have to market to market. If you sold it to a third party, a dealer, you'd have to take the loss. But now they don't have to take the loss. So they're shipping in billions, potentially $1 trillion or more of these bonds. They're not getting 80, 90 cents on the dollar, which is what they're worth. They're getting 100 cents on the dollar, which was the original purchase price. They don't have to take the loss, and they're getting cash. Why wouldn't you do that all day long? So in effect, they bailed out the entire banking system to the tune of trillions of dollars. They just blew up the $250,000 limit. Forget that. I mean, I know what the statute says, but they threw that out the window. And the moral hazard, the economic consequences, the repercussions of this are kind of unimaginable. I mean, I can sketch them. I can talk about them. To hear Jenny Ellis say it's not a bailout. Are you kidding me? This is the biggest bailout in history. And I negotiated the LTCM bailout. I lived through that. That was $1 trillion of derivatives. Through 2008, 2020, the pandemic. I go back to 1994, the Mexican tequila crisis. I've lived through all of these and been more or less directly involved in all of them. And this is orders of magnitude greater in terms of what's being bailed out. The Fed can't escape the room. So if inflation stays where it is, the Fed can't get interest rates to a real level without causing a recession, which will sink the stock market. But even if inflation comes down a little bit, that'll be a sign of recession. So you're raising rates into a recession, which will cause a recession. You end up in a recession either way. It's just a question of whether the Fed persists or throws in the towel. Now, we've seen this movie before. What's going on is an exact replay of what happened between 2013 and 2019. May 2013, Bernanke announces the taper. Expectation is they're going to start the taper in September. He chickens out. They start the taper in November 2013. They finish the taper in November 2014. Then here comes Yellen. She's going to raise rates. Take out the word patient from the statement. She doesn't raise rates until December 2015. And then she doesn't raise them again until December 2016. They went a whole year between two 25 basis point rate cuts. And then here comes Powell, and then boom, okay, 25 basis points, boom, 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 gets them up to 2.25, which is where they want it to be, and gets the balance sheet down to about $3.5 trillion. They want to get it down to about $2.5 trillion. But he's got rates about where he wants them. He's got the balance sheet on its way down, and he's normalizing. And what happens? The stock market crashes 20% between October 1st, 2018 and December 24th, 2018. That was the famous Christmas Eve massacre where the stock market fell 3% in one day. But the Fed's still tightening. The Fed tightened like a week before the Christmas Eve massacre. They tightened into the weakness. They were getting very close to crashing the stock market. They took it down 20% in 3 months, getting close to crashing it. So what happens next? First week of January, Powell comes out, okay, we're not going to raise interest rates anymore. We're going to be patient. They use all these code words. We're going to be patient. Then he starts cutting rates. Then he starts QE, I forget if it was 8 or 9, whatever, lost track of QE. He starts QE 8, let's say. And then that takes you into 2020, and here comes the pandemic, and rates go down to 0, and the balance sheet goes to $7 trillion. They were back where they were in May of 2013. Except worse, because now the balance sheet was even bigger than it was then. A complete failure. So who thinks they're going to be more successful this time? They're doing the same thing. It's going to happen faster this time because the market saw that whole 7-year fiasco from May to 2013 to May 2020, a 7-year round trip failure. The same thing's going to happen, but it's going to happen faster this time because like the market knows that the Fed doesn't know what they're doing. So the Fed's tightening into weakness. One of two things is going to happen, and it's not clear which, but it's going to be one or the other. They're going to keep tightening and keep tightening and keep tightening, try to get a handle on inflation and crash the stock market. Or they're going to lose their nerve, back off on the tightening, and then inflation is just going to rip, which will also crash the stock market. So take your pick, but it's going to be one or the other. But this idea of a soft landing is nonsense. The 2021 thesis was that, inflation grew. Part of it was base effects because, the way the government calculates inflation, it's monthly data compared to the year before. So it's year over year, monthly, then annualized. And so one could easily explain inflation in April, May, June 2021 because you were comparing it to 2020, which was the worst recession since 1946. But the base effects would run off in September, October, November. But the inflation persisted, even though the base effects were gone. So now it's like, okay, this is real inflation. It's coming from somewhere else. It was coming from the supply chain, which the Fed can't do anything about either because the Fed doesn't drill for oil. They don't build pipelines and they don't grow wheat. The Fed can't do anything about any of those things. And that's where the war and the sanctions and the continuation of COVID played a role. So, I say you can have your own views, but you can't have your own data. The data is clear. The inflation is here. The supply chains are getting worse. But these supply chain disruptions didn't start with the war. They didn't even start with the pandemic. They started with Trump's trade war beginning in 2018. I found a very good book on that written by Lorianne LaRocco. And what's interesting about her book is that she finished it in late 2019. So it's almost like a controlled experiment. It was pre-pandemic. It's easy to say that the pandemic disrupted the supply chain, which it did, and the war disrupted the supply chain, which it did. But here we have a very rigorous study of what was happening to supply chains before either one. And the answer is they were a mess. They were a mess back then because of tariffs on China and China redirecting soybean purchase orders from the United States to Brazil. That sounds easy because Brazil grows soybeans. Well, guess what? You got to get the ships to Brazilian ports. You got to rearrange all the logistics lanes. That was happening already. Pandemic made it worse, and now the war makes it even worse than that. Yeah, the world is breaking up. We're decoupling. Globalization is over. There'll be a new form of it. It's not the end of world trade, but you're going to see, maybe the Five Eyes, UK, US, Canada, Australia, New Zealand, and friends in Western Europe form a new trading bloc, but exclude China and Russia. It'll be a little bit more like the Cold War. I talked to Paul Volcker about this, but here's what happened in the 70s. Now, it started as cost push inflation. It was the Arab oil embargo in 1973, after the 1973 war, the Israel-Arab war. Then the Arabs threw the embargo on us. The price of oil quadrupled. It went from $3 a barrel to $12 a barrel. It sounds cheap, but that's a 300% increase. And then we had a severe stock market crash and recession in 1974, which at the time was the worst since the Great Depression. We've had worse ones since, but at the time, that was the worst recession since the Great Depression. Then we come out of that, and along comes the Fed, and we went off the gold standard. Nixon had an easy monetary policy in 72. It was a little earlier for his reelection effort, et cetera. So here comes the inflation. But what happened along the way, and then you had another Arab oil, actually an Iranian oil embargo in 1979 after the Ayatollah took over. So there were double oil shocks. That was supply-driven cost push inflation. But along the way, it morphed into demand pull. It morphed into a demand-driven inflation. And I lived through it. I mean, I was a young, up-and-coming lawyer at Citibank and a senior officer living in New York City. And that was the world where if you wanted anything, new furniture, TV set, vacation, whatever, you ran out, you dropped everything, ran out and did it because the price was going up so fast. So that's instructive in two ways. Number one, it shows that the Fed's always behind the curve. It shows that these things can persist a lot longer than people expect. But in my view, most importantly, because I think things are going to happen more quickly now, it shows inflation morphing from cost push to demand pull. morphing from something on the supply side to a psychological shift on the consumer side. And Volcker crushed it, but at a huge cost. Unemployment was about 11%. He took interest rates to 20%. How does that feel? Mortgagors and student loan holders and others, 20%. You talk about 40% on credit cards in that world. And people forget, well, doesn't inflation, don't you have high growth or whatever, at least, or low unemployment? No, we had stagflation. We had inflation and high unemployment. There were 3 recessions between 1974 and 1982. We had 3, 1974, 1980, and 1981, which lasted until 1982. And by the way, people lost confidence in the dollar. In the late 70s, Jimmy Carter's Treasury issued what they call Carter bonds. The U.S. Treasury issued debt in Swiss francs. Now, it was Treasury debt. You had the Treasury credit, but it was denominated in Swiss francs because nobody wanted dollars. That's how bad things were. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride. This is not the petro yuan. This is not the petro ruble. This is not a gold-backed yuan. This is not a gold standard. This is not the end of the US dollar. It's not the end of the euro. It's not the end of the world. It's not any of those things, but that's what everyone's running around on websites or whatever, shouting about. It's none of those things. In fact, quite the opposite. And this is where the Russian mentality comes in. The BRICS want the dollar to be around. They want the dollar gold market to exist, because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring one BRIC equal to a weight of gold. Again, weight's the key.
The BRICS summit in Johannesburg 2 weeks ago was attended by leaders and representatives from more than 60 countries. 6 were officially invited to join the bloc: Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates. They are set to join the founding members: Brazil, Russia, India, China, and South Africa. And while these countries are vulnerable due to their dependence on the dollar, there is no other game in town. The dollar still dominates global trade and 90% of foreign exchange transactions. Jim Rickards, the author of the national bestseller, Currency Wars: The Making of the Next Global Crisis, clarifies some misconceptions about the role of the BRICS in the global financial system. The BRICS, rather than seeking the downfall of the US dollar, want the dollar to remain strong and for the gold market to thrive. This is because they benefit from the dollar's status as the primary reserve currency, which performs the heavy lifting in the gold market. While the dollar's share of the global currency landscape has declined over the past 2 decades from 66% to 58%, its primary reserve status has not wavered. Rickards emphasizes that the BRICS are free-riding on the existing dollar-based gold system. They don't have to buy or own vast quantities of gold, and their currency isn't redeemable for gold. Instead, they base their currency's value on gold's weight and allow the dollar gold market to go wherever it goes. This strategy enables the BRICS to enjoy the benefits of a gold-backed currency without taking on the complexities and costs of maintaining such a system. We will now bring you clips from Jim Rickards' interview with Wealthian. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The value of the BRIC is not determined with reference to any other currency. It's determined with reference to gold by weight of gold. Now, and I don't know the weight, they'll pick one, but again, it doesn't matter because it's not even, it's math, it's logic. And by the way, now we're back to Aristotle's transitive law. And this is the key. This unlocks the whole thing, because Aristotle said, if A equals B equals C, then A equals C. The B can drop out. It's not even arithmetic. It's logic. It's called the transitive law. I'm certain that Aristotle invented it. If any Greek scholars know an earlier source, let me know. So what the BRICS have done is they have dodged the biggest bullet, the thing that caused Bretton Woods ultimately to fail, the thing that potentially stands in the way of all this. They've defined their currency by weight of gold. Now, a weight of gold has a dollar value, right? So A equals B equals C. 1 brick equals 1, could be an ounce or a kilo, it doesn't matter. Call it an ounce. 1 brick equals 1 ounce of gold equals today, 1970, okay? Well, through the transitive law, drop out the B and 1 brick equals 1970. $1,970. But that's constant. I mean, that logic works for a moment in time, but it's not fixed because the price of gold is going to fluctuate daily or minute by minute, right? So what's going to happen is the dollar gold, call it exchange rate, the dollar price of gold. So the LBMA, the COMEX, the London Metals Exchange, JP Morgan unallocated forward contracts, the whole huge gold market in dollars is still going to exist. The BRICS want the dollar to be around. They want the dollar gold market to exist because they get the free ride. The dollar has to do all the dirty work in the gold space, and BRICS get the free ride by declaring one BRIC equal to a weight of gold. Again, weight's the key. They just let the dollar gold market go wherever it goes, and the BRIC is worth an ounce or whatever, kilo, whatever. And the dollar equivalent under the transitive law changes, but they're not pegged to the dollar. They're not fighting that fight. So this, I analogize this. It's like you're in your house, in the backyard, your landscaper is like digging trenches and putting in plants and sweating and doing all this work. And you're sitting there with a glass of iced tea, enjoying the view. In other words, the BRICS get to free ride on the dollar gold system. And they want that system. They don't want it to go away because they get the benefit of a gold value. Now think of what the BRICS don't have to do in this scenario. They don't have to buy gold. They don't even have to own gold. They do, but no one in the world has enough gold to back a currency. This currency, the BRIC, will not be redeemable into gold. Now, maybe there's a dealer somewhere who will take it. That's between you and the dealer. But it's not like you're going to be able to march down to the People's Bank of China with a pile of bricks and say, give me the gold. They're not going to do it. So it's not redeemable. They're not going to make a market. They're not going to maintain a value because they don't have to, because it's by weight. They just get to sit back and piggyback on the dollar gold system and let the dollar do all the dirty work.
Rickards emphasizes the role of the Federal Reserve as the ultimate buyer of treasuries, with an intermediate buyer being the U.S. banking system, which has evolved from the 1950s when large banks had a substantial portion of their balance sheets in treasuries. The U.S. government influences these banks and is likely to buy bonds. This intermediate buyer pool could offer a cushion before the Fed expands its balance sheet, especially during a reset, when buying perceived safe treasuries becomes more attractive than making loans. Furthermore, he mentions the Chinese strategy, where commercial banks in China are selling dollars to support the yuan. China's major state-owned banks were seen busy selling U.S. dollars to buy yuan in both onshore and offshore spot foreign exchange markets this week, people with direct knowledge of the matter said, in an attempt to slow the yuan's depreciation. The yuan has lost about 2.4% against the dollar since this month and 6% since the start of the year.